Hi, this is Nick Katko from BMA, and welcome to today's webinar. Let me just make sure that you can see my screen. All right. I'd like you to, hold on, I got to get the video going too. Okay, sorry for the slow start technically. Please let me know, like in the question panel, whether you can hear me, you can see me, and you can see the presentation. All righty. All right, thanks for responding. And let me just close the question panel and move on. All right, so for those of you who have attended previous webinars, you sort of know how we run things. For those of you who are new, there's a copy of the handout, a copy of the presentation in the handout section of your control panel. You can download it. If you forget to do that, please send me an email. I'll be glad to send it to you. Likewise, if you are watching the recording of the webinar and would like to get a copy of the presentation, I'll also be glad to send it to you after you watch the presentation. All right, if you are a certified public accountant in the United States and you would like to receive 1 hour of continuing education credit, I can offer that to you you have to meet 3 conditions. Number 1, answer at a minimum of 3 of the polling questions. Today, we're actually going to have 5 polling questions. You have to be logged in for 50 minutes. And if you want to get the certificate, again, after the webinar, send me an email and I'll get that out to you. Excuse me. So that takes care of sort of the administrative part of the webinar. And so let's talk about what we're going to learn today. Okay, the benefits of box score decision making. So the first thing is that it does drive the proper thinking habits. Okay, and that's because lean thinking can drive financial success with the right numbers. And this is what the box score does. This is the primary benefit of using box scores. We're going to review the lean decision-making process. I don't know if you've ever encountered this, where maybe you're in a room with some people trying to make a decision and somebody pulls rank in the room, or somebody basically just jumps to a conclusion and say, this is what we need to do, without going through a complete analysis. Lean is about standardized work. Lean decision making with box scores is also about standardized work, which we will review. Then I'm going to show you some examples of the benefits of box score decision making, 6 different examples. I'll have a separate agenda to introduce each of these later on in the presentation. Excuse me, I have a little bit of a cold. And finally, we'll do some wrap up and questions. And I'll also examine the questions during the polling questions to see if you have any questions which we might be able to answer before the end. All right, box scores driving thinking. Lean is, typically it's about lean thinking. That was the title of the one of the greatest lean books ever by Womack and Jones. And it was about, it's more about thinking and that it's a people system. It's not really about, like specifically about manufacturing. And so over the years, I've realized that lean accounting is very much the same way. It's, like in lean, you have all these tools. You have, Kanban systems and pull systems and continuous improvement. And those are all tools designed to drive certain thinking habits. And lean accounting, which is about numbers, well, the numbers are really designed to do the same thing, is to drive lean thinking habits. Okay. And so as I always say with companies when I'm working with them, creating a box score is not difficult. Okay. It's getting people to use the box score because you have to practice using it and drive thinking habits. And by the way, like everything else, the more that you practice, the better that you get at it. Now, lean thinking, can drive financial improvement. And a lot of Toyota obviously is sort of the pinnacle of how lean works in companies, but there are a lot of other companies out there like Danaher, like Wiremold, Marquip United, Watlow, a lot of other companies that have successfully used lean thinking to drive financial success. And, it's not guaranteed just because you say you're lean or just because you try to put in a pull system doesn't mean it's going to drive financial success, but there's a good chance that you will see it. I was very fortunate in my job as a chief financial officer at Bullard to see this firsthand, where we were a 75-year-old company, had good sales, had good profits, and we never realized how much better we could be financially until we went down the lean transformation journey. And that has stuck with me ever since. All right, so what kind of thinking habits do we want to drive? First of all, this is something I realized a few years ago, and I really wanted to start with this. The numbers that are used in analysis and decision making, they drive behavior. The behavior drives the decisions. The decisions then sort of reinforce the numbers. And this is like a cycle. And when people use numbers to do analysis and decision making, they develop mental models. I'm talking about any manager that has to make a decision. Now, the more that you use the numbers, the more these mental models get reinforced. Okay. Now, what happens with lean in a company? It's about changing behavior. Okay. We want to think differently and we want different behaviors throughout the company. And so this requires new numbers to support that. And so this is sort of the cycle when you deploy box scores into analysis and decision making. This is sort of it's an opportunity and it's also a challenge because the box score is just a tool and people have to learn how to use the tool. Okay, so we have sort of lean thinking and we have lean financial thinking, and we want both of these thinking habits and mental models to be aligned. And this is really what a box score does. So a quick review of the box score. There's three components. There's value stream performance measurements, which measures how effective all of the lean operating practices are working, improving quality, delivery, flow. We measure capacity, which is really looking at, how much time is spent on productive value-added activities, how much time is spent on non-productive, non-value-added activities, and how much time is spent, or I'm sorry, how much time is being created due to continuous improvement. The third component is the value stream income statement, where we're looking at the actual revenue and the actual costs by value stream. In a lean company, value streams are a primary unit of organization and management. From a financial viewpoint, value streams are your profit centers. So what we want to do with box scores is understand these relationships between financial performance, operating performance, and capacity usage. These relationships are very dynamic. They're changing. If you make continuous improvement, operating performance changes. How does that impact financial performance? How does that impact capacity? So box scores, support these dynamic relationships. We want to get away from sort of more traditional, conventional analytical methods that assume static, linear relationships. The other thing the box score does is it helps understand cause and effect. Now, just about every company would like to improve their financial performance in some form or fashion. Maybe it's increasing sales. Maybe it's better control of costs. It could be both. Even in a nonprofit, cost management is very, very important because of funding limitations. So, improved financial performance is really the goal of just about any business. But the cause and effect is very important. We want lean thinking and lean accounting thinking. You have to improve operating performance. You have to improve capacity usage in order to get improved financial performance. Now, this is sort of the opposite of traditional top-down financial engineering, which I like to call it, where you have, senior leaders and financial leaders sort of plotting out what kind of financial performance do we want to see? We want costs to go down by 5%. We want profit before tax to go up by a certain percentage. And they sort of dictate what they want and then just basically force it into the organization and say, you need to perform this way, without any consideration on how to get there, okay? So again, cause and effect relationships between operating performance, capacity usage, and financial performance are part of box score thinking. The economics of lean, which is displayed here, is also incorporated in the box score and is really, really foundational to achieving financial success in lean companies. The primary outcome of most continuous improvement activities is creating capacity or more time. The financial benefit of continuous improvement is how does the company use this capacity that is being created? Are you using it to deliver better value to your customers, maybe drive a competitive advantage and grow sales? Are you using it to achieve cost reduction? And this is part of the thinking process. And again, it gets back to the fact that lean is a strategy and it's different operating practices and it has a different impact on the company. What's important in terms of the economics of lean is that it's understood throughout the company, from senior leaders through accounting and finance, all the way down to operational leaders. Now, the box score helps drive this thinking and reinforce it. So how does lean thinking drive financial performance? Well, I mentioned this already. You can increase sales without increasing costs because you have capacity. You can reduce your fixed costs over time as a percentage of sales. Okay, that's how cost reduction is measured. There's opportunities to possibly reduce variable costs and improve contribution margin. You can increase capacity without increasing costs. You can improve performance and increase capacity and not increase costs. And you can improve cash flow. For example, in manufacturing, less inventory is more cash. In any business, more profitability is more cash. And also, if your customers are more satisfied, they're probably going to pay you quicker. So, these are sort of just general categories of how lean can improve financial performance. Every company might be a little bit different, but over the years, this is what I've seen. And another benefit of box score decision making is all of this can be measured in an accurate, predictive way. Okay, so let's move on to the decision-making process. As I said in the introduction, what we want to do, we want to avoid people jumping to conclusions because, oh, well, we've made this decision many other times. We know what to do. We don't really have to study the data. We want to avoid rank in the room where the senior person in the room says, oh, I know what to do here. We don't need to spend all this time on unnecessary analysis. So first of all, just like everything else in lean accounting, what are the principles we want to follow? Well, information needs to be understandable to the user, needs to be based on the economics of lean. That's what a box score does. Information needs to be timely. It needs to be current. It needs to be up to date. Regularly calculating box scores provides timely information. Information needs to reflect reality. It needs to be actual, and it needs to represent the actual relationships. That's what a box score does. And finally, it needs to do a good job of creating the predictive value. Now, this doesn't mean you're going to be exact and you're going to know exactly what the future is going to look like. But if you're using actual information and it's current and it's up to date and it's focused on the economics of lean, you're going to do a better job of understanding what the future state can look like if the assumptions in the decision all hold. So another aspect of the decision-making process is to calculate using the box score, calculate the total incremental change over time. So how does operating performance change based on the assumptions in the decision? How does it impact capacity? How does it impact the value stream income statement? So, current state, incremental change, future state. How does the future state look compared to the current state? So this is no different than doing a value stream map, for example, where you have a current state map, you create a future state map, which represents a target based on improvement activities, or even one continuous improvement event. Same thing, you have a current state, you want to get to a future state based on improvements you're going to make. So the key here is you have to look at the incremental change over time. So obviously, a short-term decision that, it's not that difficult to calculate. But if you're looking at potential long-term decisions, for example, what does it look like if sales go up permanently? What does it look like if we have to purchase some capital equipment? Okay, so you have a larger time frame to look at, and you have to consider the total impact on both operating performance, capacity usage, and financial performance. And again, sort of, if you think about looking at each line item in the box score and looking at the time frame and thinking about the decision you have to make, it forces, well, it makes people have to think in a very similar way. I'm not saying everybody thinks the same way, but what I mean is you have to sort of follow the same process to draw conclusions or set the targets for the future state. The other aspect of decision making is to use the plan, do, check, adjust process. Now, this is foundational to lean thinking. It's the foundation of all continuous improvement activities, and even planning events. Okay, PDCA, the scientific method as applied to business, you can apply this to decision making in the same way. You follow the process. And really the key here is, number 2 in the plan phase, where, what do we expect the outcome to be? We have a decision we have to make. What do we expect the outcome to be? What's the target that we're shooting for? Then you create an action plan to execute the decision, whatever that may be, whether it's hiring people, buying equipment, making improvement activities, increase in demand. So you have this target box score you're looking at, or it could be just certain components of the box score. You sort of execute the plan, and then what you do for the check is you compare your actual box score to this future state box score that you created in the plan cycle. How close did we come to achieving the target? Now, if, like every other improvement activity, if you're satisfied with the results, okay, then you move on. How do we sustain? If you're not satisfied with the results, do you go through the PDCA cycle again? Now, the advantage of using PDCA is it really helps all people to think the same way, follow the same process, and it prevents some of those problems like I mentioned about ranking the room or jumping to conclusions. So what are some targets, possible targets in any decision? And it's pretty much what we talked about a few slides ago. What's the impact on sales and or demand? What are the changes in fixed costs? Do we have changes in variable costs and contribution margin? What's the impact on capacity, performance, and cash? So these are sort of like possible targets that you can achieve in any business decision. All right, so that wraps up sort of the thinking aspect and sort of the the standardized work. Now, let's get into sort of the real primary purpose of the webinar is to really show you some examples of how box scores can be employed. So we're going to look at how you can use box scores in future state value stream mapping, planning improvement events, measuring and calculating the profitability of increasing sales, make or buy decisions, how profitable are quoted prices, and look at capital purchases in planning. Now, just for those of you who want continuing education, there's going to be some polling questions here. Okay, there's going to be 4 polling questions in one in each of the first 4 examples. There'll be a polling question to answer. Okay, just remind you. Then there'll be a final polling question right towards the end. All right, so let's get started. So when you do value stream mapping, okay, you have a current state map, you have a future state map. The future state map is created to show improved operating performance. Well, from that future state map, you can calculate the improvement in lean performance measures. So in this case, a few improvement events, or I'm sorry, in this case, the improvement events to get to the future state are designed to improve on-time shipments, improve first time through, which is improvement in quality, and reduce inventory from 33 days to 18.5 days. And the average cost per unit is also going to go down a little bit. And serving customers better, accounts receivable days will go down. So that's a direct operational impact. You can also calculate the direct financial impact of these events from a value stream income statement. And as you can see, the direct financial impact is a reduction in material costs. Why is that? Well, we have less scrap, so actual material cost will go down. We have less inventory, so our inventory purchases will go down. So again, that's good. We can calculate actual financial benefit from these events. The other thing we can calculate is how much capacity is being created. And in this example, you can see that the available capacity almost doubles for both the people, the employees, and the machines in this value stream. So the true financial impact is dependent on how this capacity will be used. So I'm going to open up the first polling question. Which is, what use of available capacity would return the most profit? Again, you can just look at this and sort of take a guess. Transfer employees to another value stream, insource, outsource production, or increase sales. I'll give you about 15, 20 seconds more to answer. All right, I'm going to close the poll. I'm going to share the results. Okay, so most of you said increase sales. Others said transfer employees or insource production. Hide results. Hold on. I always pop up. So, what happened here? Okay, and actually, you were all there's no real wrong answer here. When they calculated three options, transfer, remove unneeded means transfer people from one value stream to another. And you can see that reduces the conversion costs, which is primarily labor and machine costs. It reduces that by about $8,000 a month, which is good. Profitability is still higher. Increasing sales, this is a good example of the economics of lean, where you're increasing sales, you have more material costs, but your conversion costs pretty much stay flat because you have enough capacity. And that drives the most profit. You can also insource, outsource production where you're going to reduce your material cost. So again, there's not always just sort of one use of the available capacity, and you have to look at the different options. But the box score allows you to think this through and model it in this manner where you can line up the options and decide, what is best. All right, next one. We're gonna, hold on one second. Okay, so we're gonna now look at planning continuous improvement events. Okay, eliminating waste creates capacity. All right, that's the economics of lean. So here's the case. You are part of a value stream team. You can see from the partial box score we have on the screen, there's 7% available capacity. And improvements must be made to get to 20%, okay? And what does that mean? Okay, we have to eliminate some of this non-productive time. And you can see that we spend 731 minutes on changeover time over in a month. We spend about a little over 12,000 minutes a month on scrap and rework. We spend 18,000 minutes a month on inspection time. Downtime is about 27,000 minutes. So those are non-value added activities, and we through the capacity calculation, we know how much time we're spending. Then there are some other non-productive activities which are more necessary, like 5S and huddles. Then there's some other general non-productive time of 3,000 minutes a month. All in all, over 52% of the time is spent on non-productive activities. And you can see how the profit is there. So polling question number 2, and again, this is sort of just looking at what information you see on the screen. Polling question number 2, let me launch the poll. So which of these improvements will yield the most time savings? And you can choose more than one. Okay, you can decrease the changeover time. You can improve quality by putting in quality at the source or JDOKA. You could put in total preventative maintenance activities, or you can reduce other non-productive time. And again, there's no right or wrong answer here. This is pretty much just getting you to think through. All right, I'll give you about 5 more seconds, then we're going to close. All right. Hold on. Every time I close the poll, the video comes up and I see myself. Okay. So which of these improvements will yield the most time savings? Okay. So we had, decreasing, we have a wide variety of answers. Okay. And again, you can choose more than one. So I don't know in how many of you chose 1 or 2. But you know what? Here's the thing, nobody's wrong here. So let me hide the results and show you a few things. So if you look at the time, let me go back one slide. Okay, so this is one of the advantages of having the box score and understanding capacity. Like changeover time, there's only 700, we're trying to look at return on effort. Okay, so, where can we plan the activities to get the most out of each activity and get to this 20%. Now, if you look at just the time factor, okay, we spend 731 minutes on changeover time. We're not going to get a whole lot out of that, even if by some chance we could take it down to 0. But when you think about quality at the source, okay, so right now, because there's inspection time and a high scrap rate, quality at the source, where the people producing are doing the quality work there, that has sort of like a double benefit of improvement where you're going to decrease the scrap rate. And in this case, it went from 20% to 15%. These are just my calculations. And because the people doing the work are doing the quality work, this idea of quality inspection time goes down also. Another benefit of quality at the source is you actually decrease the material cost because you have less scrap, and you can see that in the value stream income statement. Now, total preventative maintenance happens to be the largest consumer of non-productive time. So therefore, putting in something like a total preventative maintenance program and being able just to reduce the downtime rate from 20% to 15%, you get a big pickup in time and capacity. And, so these improvements get you to the 20%. Again, when lean thinking really takes hold in a company, a lot of people get excited about wanting to make improvements. And everybody wants to make them. The question is, not the question, but the challenge is, there's limited time to spend on improvement activities because you got to run the business also. So what's the best use of the time spent on improvement activities? How can you get, I always call it, the best return on effort? Box scores help you calculate that. All right. So now we're going to go look at sales, okay? And box scores really change some traditional analytical practices when it comes to calculating the profitability of, for example, increasing sales. So in this case, the monthly demand, which is shown on the right there, number of units shipped, increases from 4,875 units to it's expected to increase to 6,000 units a month in about 3 or 4 months. And you can see, if you drop the number in, the available capacity, which was 7% in the current state in the previous example, now is a negative 7%. So there's not enough capacity to meet this demand. So again, here's the challenge, and this is a little more complicated challenge. How would you create enough capacity to meet this demand, maintain 7%, you want to get back to the 7% available capacity, and you want to maximize profitability, okay? So let me start this poll. So which of these would you do to free up or create capacity to meet this demand and maximize profitability? Hire people, make improvements, work overtime, increase lead times. All right, I'll give you about 10 more seconds to answer. All right, let me share the results. All right, yeah, okay. Everybody who's attending here, you're learning quickly about the benefits of box scores. Yes, making improvements is always, the most profitable thing to do. Let me show you. I'm going to show you sort of two ends, hiring people and making improvements. I calculated future state box scores for both. So you can see you would have, I did the calculations, you'd have to hire 4 more people to get to, to get to, it's a little over 7% available capacity. But if you look at the income statement, you see that the salaries go up almost $10,000 a month, and you actually make less profit. And that's a very traditional way to look at things, especially in manufacturing and in a standard costing system. The reason I say that is in traditional manufacturing, you assume full capacity all the time. And you don't worry too much about hiring people because all that gets into the overhead rates or the labor rates, overhead rates, and absorption. Okay, making improvements, as you can see, let's improve quality, let's reduce downtime. You get a lot of leverage out of that. Besides being able to meet the sales, you also reduce material purchases. Because you're selling more, you're scrapping less, okay, and you have less inventory. And reducing downtime means your repair and maintenance cost goes down, and you can see that you're going to make $8,000 more a month, from $31,600 up to $39,087. The return on sales is a whole lot better. And again, I'm showing you just sort of very stark contrast. There's always things in the middle. You could look at reducing overtime. You could look at, hiring a few people and making improvements. There's lots of different choices here. The only time I think it's important to understand about the people piece is if here it was going to 6,000 units a month. But what happens if sort of longer term, it was expected to increase beyond the 6,000? That's where you might want to start hiring the people again. So make or buy, and I want to make sure we get through these examples. We have about 15 minutes left. Make or buy decision. So again, put yourself into this fictitious company, that your company requires a 15% standard margin on all products sold. So that's the price less the standard cost. That margin needs to be 15% per unit. So a customer comes to you, they'd like to buy 3,000 units per month of product ProValve 602. They would like to only pay $45 per unit. We know that in order to achieve a 15% margin, based on the standard cost of ProValve 602, the price must be $50 a unit. Now, there's not enough capacity to meet this increase in demand either. So the polling question is, what course of action would have the most beneficial impact on a box score? Okay, let me get my mouse. Let me go to the polling question. So what action would you take? Again, limited information. Would you just reject the customer's offer? Would you find an outsourced supplier to produce the product? Would you work to change the standard cost to achieve a 15% margin? Or would you use a box score to understand the impact of adding additional capacity? I'll give you about 5 or 7 more seconds. All right. So most of you said, let's look at the box score, which is really that's really what you should be doing. I'm surprised nobody said just reject the customer's offer. I thought some people would say that, but they didn't. All right, so let me show you some examples. So here's our current state box score. We have 6% available capacity. Okay, our return on sales is pretty good, 17.2%. In this case, if we outsource, and here's what's interesting about outsourcing. We gain the sales, our sales go up, contribution margin goes up, profit goes up. That's in green, but what's in red? Performance is impacted. Okay, when you outsource, in this example, on-time delivery goes down because of supply chain issues. Average cost per unit goes up. Quality goes down because you're outsourcing. And because of the supply chain, you have to hold more inventory. Now, if you look at, okay, the box score impact if we had to invest in people and machines. So again, our labor cost goes up, our machine cost goes up. We achieve more profit, more contribution margin. We have more capacity. We now have 12% available capacity. And you can see in terms of performance, productivity, delivery, quality are better than the future state and better than outsourcing. Now, average cost per unit goes up. That's expected given the investment. But overall, the lesson here is if you can make it in-house, it's better to make in-house than outsource if you can achieve the quality requirements of the customer and you have the capabilities. All right, 2 more simple examples. This one is pricing. So you have a truck repair company that has 2 value streams. They do routine maintenance services, they do major repairs. A customer comes and they would like routine monthly maintenance on their fleet of 500 trucks. They would like to pay $38 per truck. You know that your variable costs are $17 per truck. So you have the $38 customer price. What you like to do is, what is the desired price? How much would we like to make to get the profit we want? Then the question is, if the customer, if we're going to only take the $38, how profitable is it? So the first step, calculate the hurdle rate. Okay, that is the minimum contribution margin required to cover the fixed costs and meet the desired operating profit. So in this case, the desired value stream operating profit is 35%. We know that fixed costs are 22% of sales, so the hurdle rate, 57%. Then you take the hurdle rate and you divide it into the variable cost. You take the inverse of the hurdle rate, 43%, divide it into the variable cost per unit, and you get the price that you would like to charge, $39.53. But again, the customer only wants $38 per truck. Then the question is $38 still profitable? So again, you can line up your box scores. And in this case, column C, column D. 1, let's hire people, okay? Now, that doesn't increase profitability that much. It only goes up about $500 a month. So we get the increase in sales, but we have the increase in costs. Now, again, if we make improvements, that's much, much more profitable, okay? So here's the challenge. In this situation, we're looking at one customer quote, 500 trucks a month. The question really to ask would be, what are our plans even looking out beyond this one order? If we're expecting more business, or we want to grow this value stream, okay, so we hire the people, we get a lot more capacity, we can meet this 500 units a month, but it also gives us capacity to grow more without adding more costs in the future. You have to sort of balance that with the level of improvements that are needed and the time frame that you need to make those improvements to get this quote. Final example is you can use a long-term box score to understand when you may need to invest in people or machines. So this company, they did quarterly projected box scores based on their sales operations and planning process. And, looking out, you can see that given the growth in sales expected in 2012, in the second, third, and fourth quarters, that there's not enough capacity. So what this allows you to do is begin planning, okay? Again, it's a balance. What improvements can we expect to make over the course of these 2 years? Will that give us enough capacity? If not, maybe then we need to start, looking at capital expenditures or hiring people. All right, so polling question number 5, then we'll wrap things up. So how do you feel about box score decision making? Alrighty. I'm going to close the poll. I'll share the results. All right. That's a good distribution of answers. All right, so let's just wrap things up. Don't forget, complete the survey that will pop up when I end the webinar. If you would like a CPE certificate, please send me an email. And even if you're not a certified public accountant, if you just want a certificate of attendance, let me know. I'll be glad to send it. All right. If you think about lean, it's about improving processes, whether you call it continuous improvement or not. It's very sort of process focused, right? And we also want to drive financial improvement over time. And so the box score is sort of like the connective tissue, which measures process improvement, but it also shows how to achieve financial improvement through process improvement. We're trying to improve the quality of decision making. We want relevant information that's understandable, useful, and timely. We want reliable information that's valid and verifiable. That's what the box score provides. The box score supports the economics of lean and also supports lean thinking. The benefits of the box score are better decisions. And again, going back to the thinking process, the numbers of the box score drive the understanding the relationships and between lean practices and improvement. The behavior, it supports PDCA, whether it's an improvement activity, Hoshin, or a decision. And we're looking at improving economic value. You think about those 6 outcomes we've talked about. That's really, really what we want to do with our lean decision making. All right. So, if you want to learn a little bit more about box scores, practicing lean accounting, that's been out since August of 2021. It's available on Amazon. And the second edition of my first book, The Lean CFO, is going to be available in January. I started out thinking I was going to add a couple chapters, and I basically rewrote the whole book. It's in a different format, and it's more of a practice guide. So again, keep that in mind. And here are some upcoming events. Thursday, we're having our October Lean Accounting Community Chat. And then we have 2 more webinars scheduled for 2022. All right, I don't see any questions. So anyway, somebody raised a hand. Anybody want to ask a question? All right. Well, let's just wrap things up. Thanks for attending the webinar. Hope to see you Thursday at the Lean Accounting Community Chat and in any other online events. Any questions, please feel free to contact me at your convenience. And I hope all of you have a good day.